something you said on the balance of the cash flow.
Okay, yeah, so come down here. Look at this formula right there. You see something missing there?
I was trying to figure out which one it was.
It's all of them. It's all of them.
Gotcha.
There we go. Did that fix it?
Yes.
All right.
Yeah.
Love it when a plan comes together. Tyler, did you see your message?
I did.
Okay.
I fixed it.
Fixed it? You
Yeah,
good?
I fixed it.
Okay, awesome. I can't remember who else I sent messages to in those comments. Seth, I know you were one. Did you get it fixed?
Yeah.
Okay. Aaliyah, you were good. Mac, we talked. Brian, you were good. Royal, you were good, right?
Oh, I didn't check that.
Okay. I think you were good. Hey, Jake. How you feeling today?
Bit better.
Good. Good. Okay. The swelling going down a little bit?
It did not at all.
Oh, goodness. Okay. Well, keep putting that ice on there. And
Will do.
whatever you do, don't get dry sockets.
Okay.
That's the worst. Okay. Take care of yourself. We'll get started in just a minute, okay? Well, hi, Ashley. She can't hear me yet. Hi, Ashley. How's your quarantine so far? You look entirely too positive. Still nothing.
Can't be too bad.
Now-
Ask me in a week.
Do what now? I'm sorry.
But ask me in a week.
Yeah, that's the worst part. The quarantine really, really, really stinks. So. Okay, we'll get started, y'all. Comes Lentera. All right, so a good number of y'all got love notes in your pro formas that were designed to get you back on track if you weren't on track. So I think I didn't see any major problems.
Sorry.
You got a love note in your pro formas.
Yes, got it all done.
Okay, and you got it taken care of?
Yep, that was easy.
Okay, so that's awesome. What really is happening with this is I'm liking the way this is going, even though it's taking me a little time to get to do some extra grading. It's kind of keeping y'all on track, and I think the end result is going to be that those that are doing the work every week and then taking the feedback and fixing the stuff are going to make a lot better grades on this. So that's a really good thing, okay? So at any rate, just stay on track, stay on top of it. Don't let it get you behind. We're actually going to finish the bulk of the work today because the last statement that we have to do is the break-even analysis. The break-even analysis, we've already got all of the information that we need to do the break-even analysis. It's just a matter of pulling it together. Before we jump over to the break-even, though, we need to do some common sizing on our balance sheet. And Roll, had you already done the common sizing? I had one or two. Jose, were you one of them? I had one or two folks that had already done the common sizing on the statement. So kudos to you. Just stay tuned, okay? So you'll remember we did common sizing on the income statement, and specifically what common sizing means. Sometimes you'll hear it referred to as same sizing. is we want to know what certain numbers relationships are with one another, okay? So we're going to compare consistently to the same number every time. On the income statement, we compare everything to what we call net revenues. Okay, now keep in mind, I talked about this last week. Net revenues would simply be gross revenues less returns and allowances. If your company breaks it out that way, you're not required to break it that way. Okay, so in your case, it's going to just refer to sales. Okay, everything refers to sales. We want to know how much our cost of goods sold is as a percentage of sales. We want to know how much our occupancy costs are as a percentage of sales. We want to know how much our advertising expenditures are. We want to know how much our payroll expenses are, because we can then compare those to the industry. And in addition, we can compare ourselves to ourselves over time. Okay. So that's what we're looking for. Okay. On the balance sheet, when we do the balance sheet, we compare everything. Hey, y'all. Y'all were all on the same bus.
There's the elevator downstairs.
The elevator
So
was
you
like
can press
broken.
Was the outside door propped open?
No, I got in it, pressed 3, it just like went off and then on.
I don't know, but the fear.
Did you try swiping your card? So here's the problem. Something was going on weird with the locks this morning, because when I got here at 7:30 this morning, the building was locked. Everything opens automatically and it's computer controlled, and the elevator's computer controlled. I bet you that's the problem. That's the reason I asked if you try swiping. At any rate, back to this, common sizing. On the balance sheet, we compare everything to total assets, okay? Or alternately, if you prefer to say it this way, we could compare everything to total liabilities and equity, because the reality is that assets equals liabilities plus equities. Okay, so the easiest way to do it is simply to compare everything for the period to our total assets, okay? So this is the number we're talking about for our first balance sheet. The number we're talking about for our second balance sheet is not going to be year of the opening day balance sheet. It's going to be the end of year balance sheet, because what we're looking for specifically. Hey, what's up?
Can you share your screen, please?
Sharing my screen.
I don't know. I'm seeing folders.
Okay, I'm sorry. There we go. You got it now? Okay, I'm sorry. We want to compare it over time, right? There's 2 points of reference. We want to compare ourselves to the industry standards at a specific moment in time, and we want to compare over time. We want to look at changes. So compare apples to apples. We're going to compare everything to total assets for that particular period. We're going to use that same hard reference, or absolute reference, if that's what you call it. We're going to say for total assets, we'll start with it, okay? We're going to compare total assets, which is cell D21, to cell D21. So we simply say D21 divided by $D, $21, okay? That's giving us a formula where we're going to say, take this cell and always refer it to this cell, whether we're here, whether we're here, whether we're here, wherever we are on our spreadsheet, okay? So our formula is D21 divided by $D, $21. That's our absolute reference, okay? That gives us 1. Guess what? 500,000 divided by 500,000 is 1. Another way of stating that is it's 100%. Don't worry about percent right now, but you can copy that formula in the places that you need it. I just hit Control-C to do that, and then highlight and hit Enter or Control-V, okay? Control-C is copy, Control-V is paste. I think that the less I use this thing, the better off I am, and I'm old enough that when I first started using a computer, we didn't have mice. You had to do everything with keystrokes, okay? So we just copy our formula, and paste it where we want it, okay? Now notice we get lots and lots of decimal places on some, and for some we get zeros, okay? Remember my old eyes, y'all, I am so depressed. I am old. Between classes today, I went and got bifocals. I'm beyond using readers now. I'm on the bifocals, okay? I'm still using readers today because those things tried to make me drunk, okay? Make it easy on my old eyes. We want to have the same type of number format, okay? So we're gonna make it a percentage format. And we want to have, in this case, this is the only place that it is acceptable for you to have decimals. I don't want to see decimals anywhere else, okay? But on your percentages, I want 2 decimal places, okay? So you're going to format that particular column, hit percentage, and then that'll take it to no decimal places, and then you're just going to hit this little button, and it'll add 1 decimal place each time that you click that button, okay? But we want 2 decimal places, so that's 78.14%, okay? I'm gonna take my formula, and I'm gonna copy it on down. Okay, I'm just copying it in the appropriate places. Whatever, the secret here is whatever's immediately to the left is going to be divided by D21, right? And I just make that a word reference, $D, $21, and then when I copy the formula, it's always going to go 1 cell to the left divided by D21. Does that make sense? Did y'all get that? You okay, Scott?
Can you tell me what your D21 is?
Yeah, my D21 is the cell in which total assets are located.
Can you click on the formula?
Yeah. So total assets are in D21, right? And the formula is for total assets as a percentage of total assets is simply D21 divided by $D, $21. For net current portion as a percentage of total assets, it's D26 divided by $D, $21, and so on and so forth. D27 divided by $D, $21, D30, D31, D32, okay? Now, if y'all recall, I give you some rules of thumb as we've gone along, and one of the rules of thumb that I've said is you want to always have at least 20% equity in your business. 20% equity will give you a 4-to-1 debt to equity ratio. Okay. Right now, we have a 75-25 debt to equity ratio, which reduces to a 3-to-1. Okay, so I've got 25% equity, which means I've got more equity than I have to have. And I'm going to have to go in and do some tweaks on my statements. I'll upload this document and let you look at it. We'll make everything consistent because I want to make sure that you understand anytime that we change an assumption, we have to go back and change the assumption, right? Okay. Consistency. Tyler, I know that particularly we had an issue with yours as I was grading it. Right, so Tyler, I think, said that annual sales were going to be $1,865,000. Is that what was initially in your assumptions? And then she said immediately underneath that, that you were going to average, she was going to average 70 sales per month at $2,000 per sale. So this is how I'm evaluating that, okay? I'm looking at it like a banker would. I take 70 times 2,000 times 12. And it's not 1,865,000. And then when I flipped over to her cash flow statement, lo and behold, her sales for the year were 1,866,000. Now keep in mind, she's told me it's going to be 1,865. She's told me it's going to be 140,000 a month times 12, whatever that number is. And then she's told me it's going to be 1,866. You see the inconsistency there? You see the problem? The banker has to be asking at that point, well, what are your sales? You gain a tremendous amount of credibility by being consistent in what you say, okay? So we'll talk about that. I was just giving y'all time to catch up on this, okay? That's easy, right? Does everybody get that? Lintera, Jake, Ashley, y'all good? Okay, everybody's got a thumbs up. So for the end of your balance sheet, we're going to compare everything to total assets at the end of the year, which means we're going to take cell G21 and we're going to divide cell G21 by $G, $21. That means we're always going to go back to total assets at the end of the year, excuse me, okay? So I've got my formula there, and all I'm doing is Control C, and then I'm highlighting where I want it to be, and I'm just hitting enter. And since my formula never really changes, I'm just doing this really short, y'all, okay? Then I go the other direction. I'm gonna go down. Okay. So in this case, since total liabilities and equity are 100% of our total assets, just like on opening day, end of the year, right? Our balance sheet is perfectly balanced. Again, we're going to just take column H. We're going to convert the formatting on that to percentage, okay, percent. And then we're going to add 2 decimal places to it. Okay. And the entire column is formatted that way. So I just need to label my columns at this point. Okay, because I'm bleeding off there, I'm going to line that to the right and then make it a little smaller. I can make my columns a little bit wider so that I can see my whole header, that column, okay? And just to make it pretty, y'all, we'll go in and put the same borders that we have in the cells immediately adjacent to us. That tells us, right, that those things are being added or subtracted. Can actually do this like so. Can actually select multiple cells by using my control key. Do them multiple ones at a time. Okay. So you see what we wind up with. And that's it for the balance sheet. Okay. Specifically, what are you being evaluated here on? Is the balance sheet balancing, right? If your balance sheet doesn't balance, more than likely, the problem is that it's not on the balance sheet, because a lot of you said, I think, Kira, was it you? Somebody said, I followed your instructions exactly, but I couldn't get my balance sheet to balance. Well, that's because the problem was not on the balance sheet. It hasn't showed up until we actually saw that it didn't balance. That told us that there's a problem somewhere else. I know that Mary had that problem. I know that Drew had that problem. Kira, I think, had that problem. Zach had that problem. Okay. So if your balance sheet doesn't balance, it's predicated on everything else that came before it, right? So when we go back and fix those things, we didn't really know we had a problem until we got to the balance sheet. So the balance sheet balancing is a really big thing. That's why it's 25 points for the opening day balance sheet and 75 points for the end of year one. It's going to tell us a whole lot of information. So absolutely, as Rianne said, does it balance? If it doesn't, you got a problem, okay? And that's going to cost you massive points. It has to balance. Other things I'm going to be looking for, I'm going to be looking for, is it common sized correctly? A common mistake with common sizing is that people think that the numbers in this cell, these cells, should be compared to the numbers in these cells. That's not how it works. For the balance sheet, each period is a standalone, right? And what we're looking for is changes over time. So generally speaking, for example, would you expect your equity to go down in a business over time? It should go up, right? So what you see here is my equity percentage increased from 25% to 54%, and that's a sign of a healthy business, okay? If your equity percentage is, or if your equity as an absolute dollar is decreasing, that's a really bad thing. What that means is that you're taking more money away from the business than the business is earning, right? So you see what I'm saying? If my owner's draws had been 300,000 instead of 30,000, then my net equity account would have gone down by about $25,158. Okay, and that would be a bad thing. Now, as a percentage, if your equity percentage is going up, that's generally going to be a good thing. If your equity dollars are going down, that's generally going to be a bad thing. But keep in mind, this tells us, is our business healthy, right? And declining equity is generally a sign of declining health, okay? And if your equity drops below 20%, your ability to borrow money is going to be severely limited. I'm not grading you on that, Brianna. That's not part of the grade, is that your equity drops below 20%. I'm not worried about that. But I would be concerned if I was advising your business, because that makes it very difficult for you to get a loan. I saw some of you have that problem on your business, and the reason you would have that problem is either your business is losing money or you're drawing more money than the business is making, okay? So that's just one of those things that we look at to see how healthy the business is. Questions about the balance sheet? I tell you, I'm really proud of y'all. Y'all are hanging tough in there. You're doing the hard work, and it's looking really good. So just take those comments that I gave you, right, and fix your balance sheets or fix your cash flow or income statement, and then get with me. If you can't figure it out, get with me and we'll fix it, okay? We got all next week to get it done before we're going to be worried about your grade, okay? So at any rate, that's the balance sheet. Y'all have questions? Yes, ma'am.
When is it due?
If I'm not mistaken, I said it was due on the 18th, but it may be, is it due on the 11th? Is it today? It's due on the 18th. It'll be due on the 18th. Yeah. The final piece will be due on the 18th. Does that hurt anybody's feelings?
Mm-hmm.
That hurts your feelings?
Wait on this one.
It hurts your feelings that you have an extra week to do it? I hope not.
How many more components?
How many more days?
Like, how many more components of the pro forma do we have?
We're fixing to do it. Yeah, we're fixing to do it. Very simply, this is the break even. What was that, Aaliyah?
The last flap right here.
This is it. And that was the comment that I gave to those of you who were really doing well. Leah, I know you got that, and Camilla, I mean, we're almost done and you're doing great, okay? So the break-even analysis is an important piece of information. It's kind of a gut check for our business. You remember that chapter that we had about feasibility analysis? This is really the most important part of feasibility. What does it take for your money to, what does it take for your business not to cost you any money? If your business is not breaking even, it's costing you money. Because losses don't just appear out of thin air, right? They've got to come from somewhere. In other words, you got to feed the pig. If your business can't sustain itself, who's going to sustain it? You are, right? So break-even's a really important point. It's kind of the sanity check of how much does it take for me to break even and get this thing off of my payroll, get it off of my life support, such that, you know, it's not costing me money. Y'all remember the formulas for break even. Break even equals fixed costs divided by our contribution margin, where our contribution margin is sales minus variable costs divided by sales. Okay? We talked about that formula several times. It doesn't really make sense until we do it. There's some specific information that we need for your break-even analysis. It all starts with the income statement, but quite frankly, we don't care about whether we're profitable at this point. Okay? It starts with the income statement. So what I'm going to do is I'm going to come in here and I'm going to put a formula that says, go over here to the income statement and get what's in there. And then we're just going to copy that whole sucker over here. Okay? Then I'm going to copy it this way. Okay? All I did was I said, go over to the income statement. What's over there, bring it over here. Okay? Now I'm going to get rid of all of these zeros. I'm going to do find zero and replace with nothing. Find zero and replace with nothing. Why is it? Oh, I got to give it that. Okay. Find zero, replace with nothing. Why is it not doing that? Because it's looking for those as labels. I have to do it the hard way. Sorry. But hey, it's better than putting formulas in that say, go over there and get that, and go over there and get that, and go over there and get that, right? All I did here, y'all, was I replicated my income statement on the tab that we're now calling break-even analysis, okay? Well, there's nothing there, missing something. I'm just trying to make it happen really easily and really quickly, okay? Now, why there's nothing in there? That's weird. Okay. All right. So would you agree with me that what we see here on this statement right now is exactly the same thing, save a little bit of formatting boogers. It is the income statement, and it just appears on the break-even analysis tab. Okay? The starting point for our break-even is our income statement. But on the break-even analysis, we really don't care about whether we're making money or whether we're losing money. We really don't care about cost of goods sold and operating expenses. We care about something else on the break even. We care about our fixed and variable expenses. Okay? Because we have to know our fixed cost and our variable cost to calculate. Remember, what do we have to calculate our contribution margin? Sales and variable cost. Sales minus variable cost, in parentheses, divided by sales. So those are the two things we need to know in order to calculate our contribution margin. What are the two pieces of information we need to calculate our break even? Fixed cost and contribution margin. Okay? So instead of looking at it in terms of cost of goods sold and operating expenses, what we're going to do is look at it in terms of fixed costs and variable cost. Okay? You with me? Okay. So what I'm going to do is I'm going to create a little bit of room in here. Okay? And I'm going to create a little header that says variable costs. And I'm going to try to identify those variable costs. Okay? Would you agree with me that cost of goods sold are a variable cost? The more I sell, the more my cost of goods sold. The less I sell, the less my cost of goods sold. Isn't that sort of the definition? Variable costs are those that go up or down based on our level of sales. Okay? By the way, we can completely eliminate the word profit from our break even and expenses. We can eliminate that from our break even because we don't care about those terms. Okay? We care about fixed cost, variable cost, and sales. Okay? We're going to create another little header that says fixed costs. I might need a little more room in there because I have a couple of other variable costs. Okay? Is depreciation fixed? Does it go up or down based on our level of sales? Okay, so if it doesn't go up or down based on our level of sales, what kind of cost is it? It's a fixed cost. Does our property tax go up or down based on our level of sales? What about our property taxes? You could argue that utilities would vary based on our foot traffic, right? The more customers that we have come in, that means the more time that our doors open. And when it's 112 degrees in the summer, the harder our air conditioner has to work. And when it's icy in October, the harder our heater has to work. But what's really driving the variance in our utility cost? Seasons and foot traffic, okay? Foot traffic is not sales. Seasons are not sales. So in this case, this is sort of a judgment call, y'all. In this case, I would say that my utilities are not a variable cost. They're a fixed cost. Okay? If you're in the manufacturing industry and you have, like if you use a lot of water in your manufacturing process, like vitro architectural glass does, or if you use a lot of natural gas, like Halmet does, those utility costs would be variable costs, right? Because the more they make, the more water they have to have, or the more fire they have to have. Okay, so sales does cause the utilities there. It's purely a judgment call. Okay, Sky, you're doing a hotel. I would say in your case that utilities would be a variable cost, right? Because the more occupancy you have, the more of those little ductless units that you have running. Okay, make sense? I mean, in a hotel that, you know, they don't run every air conditioner in every room full time, right? They only run it on the ones that are occupied. Okay. All right. What about wages and salaries? Our office manager is a fixed cost. How about our commissioned salespeople? How about our delivery driver? I would say that this is variable. Okay, and here's why. If there's no deliveries to be made, what am I going to do with my delivery drivers? I'm going to not pay them. I'm going to send them home. Okay. So commissioned salespeople. Okay. Tell you what we're going to do. We're going to call that wages, right? Because it's an hourly wage or a commissioned wage. It varies. Okay. And down here, we're going to call this salaries. And what I'm going to do is I'm going to take our commissioned salespeople and our delivery drivers, and I'm going to move them up here. Yes, ma'am, Camilla? If you have them all combined in one, I wouldn't get to that level of granularity. Okay, I wouldn't. Remind me what your business is?
Gas station.
Yeah, gas station. Yeah, I wouldn't try to break that out. I really wouldn't. Okay, you don't have commissioned salespeople, right? You got to have somebody working. I mean, you got to have somebody working the counter, whether you have sales or not, right? I mean, you might make a manager work the counter if you're not busy enough for the manager to have enough to do. But honestly, I don't think that I mean, you got to cover 24 hours a day, 7 days a week, 52 weeks a year. So I don't think that your employees vary with sales much. Okay. You could argue it either way, but it is sort of a judgment call. Now, payroll taxes, y'all. This is sort of nuanced, right? We got $50,000 for our delivery drivers. We got $381,000 for our commissioned salespeople. So we got a total there of about $450,000 of payroll that's variable. Meanwhile, we've only got $48,000 down there that's fixed. So in this case, what would you say about payroll taxes? I would say that they're variable, right? Because most of them are variable. Okay. So again, we just copy that or just cut it and paste it up there. Workers' compensation. Here's going to be a nuance, y'all. Workers' compensation, we put in an assumption that workers' comp is equal to 3.5% of our total payroll. Here's why it's not a variable expense. When is it payable? At the beginning of the year. It's payable in advance, okay? So if our payroll isn't as much as we expect it to be, or if it's more, we're not going to catch up until the next accounting period, right? So in other words, it's not going to vary in the short term. Advertising, they should be the opposite of a variable expense. Very fixed. Interest expense and rent, those are obviously fixed. Okay. So we've got our variable cost broken out and we've got our fixed cost broken out. And I'm just making it pretty while y'all are catching up. That's all I'm doing, okay? Remember, I don't want to see any decimal places. When I copied it over, I lost my formatting. So number, no decimal places, use the 1,000 separator. Did I say one decimal? There we go. All right. I'm just getting everything lined up. Okay. Now, you might argue that rent is a variable cost. In the short term, it's really not unless you pay a percentage of sales for your rent. If you locate your business in the mall, that's exactly how their rent is structured. Malls typically charge somewhere 15, 18, 20% of sales, depending on the store. Okay? Because keep in mind what you get with that is you get your rent, you get all your utilities, because you're using the same air conditioner as everybody else in the building, and you get lots and lots of walk-by traffic. That business is a destination. Okay. All right. So now we'll simply total those up. The biggest mistake that I see people make here is they leave something out. What do I mean? I mean, in our process of moving stuff around, something gets accidentally deleted. Okay? If something gets accidentally deleted, your break-even analysis is not going to work. Because if we delete a fixed cost, right? Remember, that's the numerator of our fraction for break-even. It's fixed cost divided by our contribution margin. If we delete a variable cost, that changes our contribution margin. Sales minus variable cost is in the numerator, okay, divided by sales. So the biggest problem when people's break-even doesn't work is they delete an expense that should be there, okay? So we've got sales, we've got variable cost, and we've got fixed cost. Okay. Oops, put that in the wrong place. So now we have the right stuff to calculate our break even. Okay. So we're just going to simply type our formula in here. Okay. Break even equals fixed cost divided by variable cost, or excuse me, contribution margin. Said that one time too many today. Fixed cost divided by contribution margin, where, skip a couple of lines, contribution margin equals sales minus variable cost divided by sales. Okay? And that's our formula. The rest of it's easy. It's just math. All right? Okay? So contribution margin. Just come in here and put in a formula. Our formula is very simply this. It's sales minus variable costs divided by sales. Okay? That tells us our contribution margin is 0.24251. It's better stated as a percentage. Okay? Again, 2 decimal places. Jose, I'm going to go on the assumption that you've probably had operations management. No? Who has? Okay, 4 or 5 of you have had operations management. In operations, Dr. Patterson teaches break even in units. Okay? I'm talking break even in percentage. Okay? When he talks about contribution margin, it's simply sales minus total variable cost. You don't divide it by sales. Don't be confused here. I want your break-even amount in dollars, not in units. Okay? And in so doing, I need to convert that to a percentage. That's why I divide sales minus variable cost by sales. That gives me a percentage. Okay? What does that mean? It means that 24.25% of every sale we make is contributed to something. Okay, that's what the contribution margin is. It's contributed to something. If we're below the break-even point, it's contributed to cover our fixed costs. Okay? Once we reach break even, 24.25% of every sale is contributed to what? Aaliyah, you want to hazard a guess on that? Seth? It's very simple. Okay, so what's happening? All right, think about our formula. Break even equals fixed costs divided by contribution margin. Okay? So in other words, when we're below break even, every dollar of sales is contributing 24.25 cents to cover our fixed costs. Once we cover all of our fixed costs, it's now contributed to something else. Do you know what else is contributed to? That 24.25 cents gets contributed to profit, right? Because we've covered all of our costs now. By definition, the formula for our contribution margin takes into account our variable cost, right? The formula for break even takes into account our fixed costs. So if we've covered all of our variable costs and we've covered all of our fixed costs, what do? We make a profit, okay? So we calculate our contribution margin, okay? And then we put in another formula. That formula is going to be very simple. It's going to be fixed costs divided by our contribution margin. Okay. In my case, it's cell E23 divided by cell D29. Okay. My break-even point is 2,106,000. $2,106,678. That's my break-even point. Okay. Now, some of you folks are losing money in your business. What that means is you haven't yet reached break-even. Your sales are lower than break-even. Okay. I have a very simple test for my business to see if my break-even is correct. I'm going to open up your Excel spreadsheet and I'm going to come right over here and I'm going to put in a formula that says take my sales, subtract my break-even point from that, and then multiply that times my contribution margin. This is what you can do to check to make sure that your break-even is correct. Okay? In other words, what this is telling us, this is just a check for me. This is not something y'all need to turn in on yours. Okay? What is this telling me? E2 is how much my sales are. D31 is how much my break-even point is. So what is that? It's telling me how much above break-even am I, right? And then if I multiply that times break-even, what do you think it's going to tell me? If I do it correctly, 274, 842, 30 should be my net profit. That's my check, y'all. Okay. So what's my check? Okay, let me show you that again, because it seems like hocus pocus, but it's not, right? So here's the deal. In checking this, this is the way that I check you, and it's the way that you can check you before you turn it in to make sure that you've done it correctly, okay? I want to know, how much do I exceed break even? Okay? This is assuming that your business is profitable. And if your business is not profitable at this point, that's to say if you've got negative net income in your business, I recommend that we go in and massage the numbers a little bit, because I just don't want to confuse you on anything, okay? Let's raise your sales or lower your expenses until you are profitable. Looking at you, Scott. You got another issue that we need to talk about, Aaliyah. I think that your business is slightly unprofitable. Just increase sales enough so that you think the business is going to be profitable. Okay? So what is this asking? This is asking, by how much do I exceed break even? Okay? So my sales were, what, $3.5 something million? Okay? It's sales, okay, 3.24 million. It's sales minus whatever my break-even point is. Okay, that'll tell me by how much I exceed sales. And we know that for every dollar I sell above break-even, I get to keep 24.25% of every dollar. That's profit. So if I can figure out how much I exceed break even, multiply it times my contribution margin, that should exactly equal my net profit on my income statement. Hocus pocus? It works, right? That's my check for you. Otherwise, y'all, I go crazy trying to chase down numbers all over the place. I'm telling you how I grade this, right? And if this is the case and you've got it formatted and laid out correctly, you get the full 25 points for it, right? But if I do this little exercise here and it doesn't work because you're not yet at break even, then I've got to dig into it a little deeper and it becomes harder for me to grade. And what happens when something becomes harder for the old man to grade? He gets grumpy. And it's not that you're intentionally going to lose points, but honestly, if I can eyeball these things and they look right and the formulas work, then I think you've done the work right, and it's going to be much more likely that you get all the points. The more time I spend looking at it, the more opportunity to be critical that I have, and that's where it costs you points, okay? So that's just a check. But the concept of break even is just very simple. It's the point at which I'm not making any money. My business is breaking even. I'm not having to feed it anymore, okay? So if my sales were 2.1 million, I'm breaking even, okay? Because my sales are about 1.1 million higher than that, I get to keep 25% of that money, okay? And here's something that might be tempting to you guys. You might say, well, you know, we had that conversation and And let's see. Yeah, Mac, I'm looking at you. And Scott, I'm looking at you. Mac's doing insurance. And I said, Mac, Scott, and Ash, you don't have inventory, whoever it is, you don't have inventory because your business is a service business. There's a danger there that if you think, I don't have cost of goods sold, I don't have inventory, I don't have variable cost. Every person who works in an insurance agent's office is going to be on commission. The more nights rooms that you sell, the higher your utilities and the higher your custodial, right? And the higher your laundry, all that kind of stuff. So you've got variable costs. You have variable costs. It's just that you don't have them up there as cost of goods sold, okay? So does that make sense? It's really kind of easy when we get to this point, right? Hopefully. Okay. And you'll see, in order for you to get full credit, I want a little interpretation. Okay. This is all the interpretation you need is therefore my sales exceed break even. Break even does not have two B's, it's got one. My sales exceed break even by whatever your sales are minus your break even number, okay? $1,133,321.57. Because really, here's the best way for me to grade this. I've got my calculator out on my phone and I just take 1133,321.57 times 0.2425 should equal 274. Okay. $274. Questions about the break even? You don't do common sizing on the break even. You don't have to do that. Remember, everything that's on the income statement will be on the break even. But we don't worry about gross profit and net profit, and we don't worry about cost of goods sold. We have different terminology on the break even statement. Okay? On the break even, we worry about variable costs and fixed costs. And I'm not going to challenge your thinking, okay? If you make a logical case to me that your utilities aren't going to vary based on your occupancy rate, I'm not going to critique you. But if you come in there and tell me I don't have any variable costs, therefore my contribution margin is 100%, therefore my break even is actually equal to my fixed costs, that's not really valid. Okay.
What about mine? I don't,
Okay.
that's what I was thinking.
Okay, so you're going to have some variable cost. I would say in your case, because she's doing an ice skating rink, an indoor ice skating rink, open 365, okay? Open year round. What's going to vary based on sales? How about your staffing? How about your utilities?
I had it where it was different during certain months.
Yeah, but it's going to vary based on sales. The most obvious thing that I could see would be your staffing, right? Because if you're not busy, you send people home. The busier you are, the more people you need.
So what percent, should I, because it is just a set. I'm just trying to figure out what percentage I would use of my wages.
I'd say all of your wages.
So just do all of them.
Yeah, do you have like a
Besides
manager?
Yeah, besides the one manager.
Yeah, so you've got a manager, so everybody else would be subject to being sent home.
Okay, that sounds good. I wasn't sure when you were talking about, I wasn't sure.
Yeah. Well, it's just like this, with the office manager, they're a $4,000 a month salary,
Right.
right? My commission salespeople, you know, they can make as much, the sky's the limit for them.
Right.
The more they sell, the more margin they hold, the more money they make, right? But if sales go down, the less money they make, okay? Other questions?
So what if I have like a supervisor other than manager?
Okay, so is that supervisor going to be on salary? Okay, if that supervisor is on salary, and let me think. Chanel, are you paying $2,100 a month? Is that
The
your,
supervisor?
yeah.
So?
Somebody is paying, they're paying a salary to someone that's actually less than your hourly workers are making. I don't know who that is. I was wondering if it was you. I would say supervisory is going to be fixed. Your hourly workers are going to be variable. Okay? Other questions? This is easy, right? All right, so let me talk about just some general stuff, okay? Just commonly accepted principles, okay? First and foremost is you got to be consistent. Now, for the most part, y'all, I haven't gone back. When you've turned in your cash flow, I've not really gone back and compared it to your assumptions. If you'll recall, a couple of weeks ago, I changed my sales because I was below break even, right? That was when we were doing the income statement. I doubled my sales. So if I doubled my sales, I need to make sure that my assumptions match, okay? So it says we expect to sell 1.8 million in the first year, or 150,000 monthly average. That is obviously not correct, okay? Tyler, this directly applies to you because I know that you've got that situation. For some of others of you, I don't have any idea what business you're in. I have no idea what you're selling. Okay? You say that you're in retail, or you're in wholesale, or you're in manufacturing, or you're in service business. I have no idea what you're selling. And if I have no idea what you're selling, I have no way of knowing where the heck the numbers come from. Okay? So what I would want to do in this case, and you know, I think I'm gonna make it a little more reasonable. So I'm going to say I'm gonna sell 2.4 million. I'm gonna show you the power of these pro formas if you've done stuff right, okay? 2.4 million is a $200,000 monthly average, right? Okay. All right. So I need to recalculate my beginning inventory as well. Some of you told me that you were going to keep 104 days worth of inventory. I have a really hard time believing that your days inventory are exactly the same as my industry. Okay. You'll remember, where did that come from? It came from the IBIS World Report. Average days inventory, 104.3 days. I calculated that, okay? So just doing a little math here, okay? If I have 2,400,000 times 0.608 divided by 365 times 104, that means I need to have 415,000 in inventory. Okay, so this assumption right here is wrong. And I will fact check you. I'm just going to round that up and say 416,000 in beginning inventory. Okay? And instead of averaging 50 transactions monthly at $3,000 each, if I'm going to sell 200,000 a month, Okay, how do I get there? I'm going to average 80 transactions monthly. And I'm just changing all my assumptions, but more importantly, what am I doing? I'm making sure that my numbers match throughout, okay? 80 transactions monthly at 2,500. If my math is right, that's 200 grand, right? Okay. All right, so on my sources and uses of funds, my beginning inventory is now incorrect. It's 416,000. That cuts my working capital really close, y'all. You see how changing one thing changes another? If I look at my cash flow, I've got a negative cash balance before I open. That's got to be covered. In other words, if I did not cover that cash balance before I opened, I'm out of business before I ever start. Okay? Fortunately, I didn't go all in at the beginning. So I'm just going to take another $50,000 out of my pocket. I mean, after all, we're playing with funny money here, right? I mean, I'm not requiring you to actually have this money. Make sure that when you're turning in your pro formas for the bank, when you are in business someday, if you're say that you're investing $175,000 in your project, that you actually have $175,000 to invest. Because if you don't, there's a two-letter term or two-word term for that. Bank fraud. Okay, and if that's a federally guaranteed loan, that's a federal offense. If it's an SBA guaranteed loan, it puts you in federal prison about that. Okay? So you don't want to do that. Okay? I could have just as easily gone in and said, I'm going to increase the amount of my loan by $50,000 because I had enough equity to do that, right? Jose?
What did you say the ratio was supposed to be for investment and loan?
At least 20% equity, 80% loan. At least that, okay? But I want to show you the power of that, okay? When I put in the $50,000 additional money in owner's investment, I didn't have to go in and change my cash flow. When I changed my beginning inventory on my sources and uses of funds, I didn't have to change my cash flow. Okay? Now I do need to change my sales because my sales are not going to be 3.24 million. They're going to be 200,000 a month. Okay. We need to make sure that we've got sufficient cash in the business, that our money never goes negative. Okay. I will judge you on that. If you end up any month in your 12-month cash flow with a negative cash balance, you're out of business. Okay, don't want that to happen. So now we're on the cash flow. We've got decent cash flow throughout the year, and our ending cash balance is the same. We didn't have to change anything, right? Oh, and by the way, I'll just jump ahead to the rest of the story. Our balance sheet still balances. Right? Because what we've done is now we've created a very powerful document that we can change numbers on one statement. If we'll change them the first time that they appear, it populates throughout all of our statements, right? In this case, Jose, it gives me 31.82% beginning equity. Right? That's just 175 divided by 550. Okay? And what often will happen when I'm doing this with a real business, y'all, what will often happen is if the founder of the business comes in and says, hey, I've got a negative cash balance here, I need to fix this. I say, can you come out of pocket with any money? No, I'm all in. Okay, well then the only other option is to increase your loan. Keeping in mind all those other financial ratios, making sure that you don't drop below that 80-20 debt equity ratio. Okay, increase the amount of the loan, make sure it doesn't affect anything else. I just simply said, I don't want to go in here and change this loan. But it could very well be that you need to do that. This is, I would describe these pro forma statements in the real world as a very iterative process. That means you're going to repeat stuff, okay, until you get it to where it looks right. Y'all have been doing this so long, it just sort of happens that, you know, I kind of know where the numbers are that make it look right. It's not that I was that lucky, it's I've done it so much, right? Okay. So our income statement is correct. Our balance sheet is correct. Our break-even analysis is correct. Okay. I didn't have to change anything. My contribution margin changed a little bit because my sales went down. Okay. Break-even number's still the same. Okay. If I take that 249 and multiply it times my contribution margin, it's 58,818. Oh, well, look, it's 58,818 there. And let's look at my balance sheet to make sure that my earnings are 58,818. It's pretty powerful, right? It's pretty powerful, right?
Yes.
Okay. So formatting, okay? Remember, I don't want to see all those decimal places. I only want decimal places on your percentages for your common sizing. That's the only place that they really should show up. In fact, I can get rid of them there, okay? What I'm looking for is I want the numbers to line up nice and neat and be very easy for me to read. Oh, that's 60K. If I'm trying to diagnose something, I look at utilities to make sure that they're 60K here, and then I'll look at the cash flow to make sure that utilities are 60K there. Don't think that you need to impress me with all of your fancy formatting, but honestly, it is helpful if you'll kind of indicate where your totals are and your grand totals are by delineating with borders, okay, like that. That's just a formatting deal. It also helps. Sometimes I have to print your statements to grade them. I don't plan to do that, but it's just that there's little goblins that I'm trying to track down, and the best way for me to track those down sometimes is to print them and have them side by side, okay? If I do that, it's very helpful to have at the top of the page information about what I'm looking at. And again, if you were doing this for the bank, you certainly would want to have that on there, okay? Pro forma statement of cash flows. And then you would also put the name of your business. I don't even remember what I named the business. I didn't, okay? So it's Scott's Furniture, okay? And we would want to have a title on every tab so that if I print it, what's going to happen? It's going to show up.
use it like
Sources.
header?
Huh?
Can you do it like on a header?
You could. Here's the danger. I don't really want you to get very, very technical with it. Those are kind of advanced things that don't always translate. I see you're using an HP computer and I've got a Lenovo. That would very easily translate. But when you've got Seth over there using a MacBook, it doesn't necessarily translate. It's not done the same way. Okay. So do that. Okay. Make sure all your formatting on all your pages is the same, right? Again, use your underlines where appropriate. All of this is really style points. Okay. I'm not going to print your loan amortization, so just don't even worry about the way it looks. Your cash flow, we've set up the way that it looks. Your income statement, we've set up the way it looks. We just need to have a title on it, right? Our balance sheets, a title on that, okay? So if you'll read those instructions, one of the things that I very much ask you to do is to give me a PDF, okay? I want a single PDF document with everything on it in that PDF, okay? And I want it to look like, I want that PDF to look like it would if I printed it. Okay, so in other words, I'm challenging you now to go a little step further with Excel. I want you to look at your page layout, your formatting of each page, and make sure that if I take that PDF and I hit print, it's going to give me exactly what you want me to see. All right? So you will turn in the PDF. Okay? That means that you need to set up each page to show exactly what you want it to show. So you're going to highlight the area that you want to be printed. You're going to select set print area. Okay? You're going to set the orientation on each individual page. You're going to do that on each individual page before you save it as a PDF. Okay? Print area, orientation's good there. Income statement. I don't know how I didn't get that up in the corner, but at any rate, I'm going to do print area. On our cash flow, this is something that drives me a little bonkers, y'all. Okay? Make sure you get the whole area. And on this one, make sure when you do it that you change the orientation on that one to landscape. Okay? Portrait is this way, landscape is this way. Okay? On your sources and uses of funds, I don't care if you put your sources and uses of funds on your assumptions page if you wanted to, because it's a lot of information or little information that's going to be on a page by itself. So if you've got room on your assumptions, you can put it there. Okay? Here, make sure that we get all of our area. We're going to do print area, set print area. Orientation here is portrait. Okay. So now we've set all of our orientations. We've set all of our print areas. We want to select the tabs that we'd like to print. Do not select the loan amortization. I don't want that in your PDF. Okay. Then do file and print. It's going to give you a preview of what every page looks like. Okay. For this page, that's fine. For this page, that's fine. For this page, that is not fine. because what's happening here is it's running off onto a second page. Okay? Fit sheet on one page. You see what that looks like now? Okay? If you format that landscape, what you wind up with is a lot of itty bitty numbers up here. Okay? And that's very hard for me to read. Hard for me to grade, hard for you to get a good grade. Okay? So when it's all said and done, okay, what happened when I did that here is it changed and put all of my sheets landscape. I don't want that, okay? So I need to go back because I had all of them tabbed when I did that. Orientation, portrait, orientation, landscape, orientation, portrait, balance sheet, portrait, break even, portrait, and the assumptions also portrait. Okay, so now we'll select my tabs again. What am I trying to tell you? I'm using control to select those tabs, by the way. You can skip tabs when you use the control button. When I do print here, okay, when it's done correctly and you preview it, okay, you save it as a PDF, okay? Microsoft Print to PDF creates a PDF document for you. When you hit print, it asks, where would you like to save this bugger? Save it somewhere you can find it. I'm saving it on my desktop, okay? When your PDF is created, go look at it. Make sure that it looks the way that you want it to look. Make sure you don't have anything running off the page. Make sure you don't have anything that's going to be too challenging to the old eyes. In other words, put an eyeball on it before you turn it in, okay? Put an eyeball on it when you turn it, before you turn it in. And in this case, you're going to turn in 2 distinct files. I haven't created the Dropbox for it yet. Okay, it's not due today, it's due next Wednesday, the 18th. I will create the Dropbox tomorrow. You're going to turn in 2 files. You're going to turn in this PDF document. That's the first file. Remember, that's one file with 6 pages, and if I hit print, it is exactly what you wanted me to see, okay? So you're going to upload the PDF to Dropbox. The other file that you're going to turn in is your Excel workbook. That's the exact same thing that you've been doing all along, okay? The Excel workbook allows me to get inside of it if you've got problems to figure out where your problems are, right? You can figure out where your problems are. So here's the deal. This will be due before midnight next Wednesday, 1 week from today, the 18th, okay? If you need help on this, I was supposed to be going to a board meeting in Lubbock, and I said, nope, I'm not doing it. I can't afford to spend 8 hours driving to go to a 3-hour meeting. So I'm here tomorrow. I'm here most of the day on Friday. Y'all know what my Mondays and Wednesdays are like. So if you need help on this, the day to see me is tomorrow, Friday, or Tuesday. Okay, and I will help you to fix it if you need to see me. Okay, I will help you get it right. But if you come to see me next Wednesday, or if you ask me to help you next Wednesday after class, I'm sorry, that window of opportunity has closed. Okay, because just like today, I'm so burned out today I'm ready to go home. I don't want to mess with y'all. Sorry, love you, mean it, but I gotta go. Okay? Questions from our online folks? Y'all good?
No, it's good. Yeah.
Okay, awesome. All right, well, go forth and do good. Y'all stay safe.